Trump will initiate a hyperinflation cycle in 2025. Have you been waiting for a chance to strike it rich in 2025? Don't let it slip by. This year, if you cling to outdated habits, going to work, earning a salary, saving money, cutting expenses, and stashing it in a bank account without daring to spend or invest, you're essentially different from someone helping a stranger pay off their debts. Worse yet, you're not only helping them clear their debts, but that stranger then takes the money you've worked so hard for and spends it lavishly everywhere. The result? They get richer while you get poorer. Why does this happen? Because the world is about to flip upside down again, punishing those who only know how to save. What does this mean? Greetings, ladies and gentlemen. Over the past 4 years, have you benefited from the money the U.S. has been printing? You might realize that even if you didn't buy U.S. stocks that soared in value, it's okay. Housing prices in the U.S. have risen too. Even if you didn't invest at all and simply kept your money in a U.S. bank, you could still earn 4 to 5% interest annually. And if you did nothing but convert your money to dollars, for instance, if you're Japanese and swapped all your yen for dollars, what would happen? Your wealth would have passively grown by 50%. So, if you converted your money to dollars, bought a house in the U.S., used that house as collateral to borrow funds, invested that loan in U.S. stocks, and then used those stocks as collateral to deposit into a fixed-term savings account, you'd have maximized the gains from the money the U.S. has printed over the past few years. But starting this year, that strategy is about to change completely. Over the last 4 years, Biden administration played the high interest rate card to pull dollar flows from around the world back into the U.S., inflating the value of American assets. However, in the next 4 years, the Trump administration is expected to reverse this approach. He wants to lower interest rates, devalue the dollar, and ramp up spending, shopping like crazy on a grand scale. Recently, he even announced his desire to buy Greenland. So, where will the money come from? In my previous video, we saw that global cash flows are currently flooding into the U.S., but most of it is being used to buy U.S. stocks, not government bonds. This means capitalists who own stocks reap the profits, while the U.S. government, the issuer of bonds, doesn't benefit as much. For example, Warren Buffett can sell stocks and sit on the largest cash pile in history, while the U.S. government currently has only about $7 trillion left in its treasury. Yet, each month, government spending exceeds revenue by $200 billion. At this deficit pace, the treasury will run dry by April or May of this year. Even so, the U.S. government will never run out of money to spend because they always rely on one trick. The Federal Reserve will fire up the printing press, print more dollars, and buy U.S. government bonds. This happened in 2009 with $2 trillion, and in 2020 under Trump with $5 trillion. Each time they print money, the money supply grows, the dollar loses value, and inflation rises. For example, if I borrow $10 million from a bank and the dollar weakens, I still repay $10 million, but its real value might only be $8 million. Meanwhile, if you save $10 million, its real value also drops to $8 million. That $2 million difference is essentially transferred from you to me. Isn't that like you lending me money to help pay off my debts? Right now, the U.S. owes over $30 trillion. How will they repay it? This is how. If you lend the U.S. government $10 million, in 10 years they'll repay you the principal plus interest, but its real value might only be $8 million. Back then, $10 million could buy a mansion. Now it might only get you a regular apartment. Starting this year, if you earn money and let it sit idle, the wealth you've slaved away for will belong to someone else. It'll be invisibly siphoned off. If you want to protect the money you've worked so hard to earn, avoid becoming a pawn or victim in this game. Or even seize the opportunity to grow your wealth and break through social barriers. Follow my channel. In the future, I'll share more valuable insights with you. Worried you'll forget what you've heard and waste your time, like this video? It'll automatically save to your playlist, making it easy to revisit and follow along. First, everyone needs to mentally prepare for more frequent money printing. In the past, it might have taken decades for this to happen once, but the cycle has shrunk from 5 years to 3 years. And now just 2 years. That means, starting this year, we need to get ready for a period of high inflation. What does this mean? How should we invest in U.S. Treasury bonds, T-bonds, to profit? When I was in college, my professor taught me that when the economy is booming, we should buy stocks because companies earn big profits, driving stock prices up. When the economy crashes and companies lose money, we should shift to safer assets like U.S. Treasuries, the world's safest investment. It's like lending money to the U.S. As long as the country doesn't go bankrupt, you're guaranteed to get your money back. Historically, people bought treasuries during tough economic times when most other assets were crumbling, because treasuries offered stable interest. They were seen as insurance, like home insurance. You don't buy insurance to make money, but to protect your assets' value. If disaster strikes, ensuring you don't lose everything. Risk hedging assets like treasuries are for capital preservation. But if you look at the price of 10-year U.S. Treasuries over the past 20 years, they've consistently risen. What does this mean? It seems my college professor might need to update his lecture. Whether the economy is thriving or tanking, treasuries remain in demand. For instance, when markets were in chaos, treasury yields fell below 1, but their price hit a record high of 1. That means, if you spent $100 to buy a treasury with a 1% annual yield, you'd earn $1 in interest. But because so many people rushed to buy them, the market price soared to 1. If you wanted to buy it from me, you'd pay $140. Yet when it matures, you'd still only get $1 in interest. So with $140 invested, your real yield is less than 1%. It'd take over 100 years to double your money. That's a lower return than almost any other financial investment or insurance. Yet, over the past 20 years, countless people have flocked to lend money to the U.S. through treasuries. Why? Simple. Treasuries can increase in value. I buy at $100 and sell to you at $140, pocketing a $40 profit. This means that over the past 20 years, people buying treasuries weren't just hedging risks, earning tiny interest. They were speculating. Much like playing the stock market, profiting from price increases. After the 2000 dot-com bubble, the Federal Reserve cut rates 11 times in a row, from 6.5%. Treasury yields dropped too, pushing their prices up. A treasury I bought at $100, with a 6 yield became more valuable when new treasuries only offered 1%. If you wanted my 6.5% treasury, you'd pay $120. So, the market price rose from $100 to $20. The lower the interest rate, the higher the treasury price. Since 2000, the U.S. has used low rates to stimulate the economy, and treasury prices kept climbing. People rushed to buy because they could sell at a higher price. Especially after the 2008 financial crisis, Treasury prices soared as the U.S. not only cut rates, but also began printing money for the first time. Similarly, during the 2020 COVID crisis, the Fed printed money again, and Treasury yields hit 1%, yet people still scrambled to buy them. Why? Because everyone believed that in the future, the U.S. would face crises, and each time, the U.S. responds with two moves: cutting rates or printing money to buy treasuries, essentially lending to itself. Either way, treasury prices rise, and holders can sell for a profit. Treasury investors often use leverage. For example, if I buy $10 million in treasuries, I can use them as collateral to borrow $8 million from a bank, then use that $8 million to buy more treasuries, repeating the cycle. So, even if treasury prices only rise 5%, with leverage, my real profit could hit 50%. In the past, the fear was that no crisis would occur. If there's no crisis, the U.S. won't cut rates or print money, and treasury prices won't rise. It's like buying fire insurance. You don't want your house to burn, but if it does, you hope for a big payout to buy a better one. Treasuries used to be for risk protection. Now, people buy them to make money, and that profit comes from the money the U.S. prints. So, what's the truth of this world? Government print money. And why does economics claim inflation is good? They say rising prices signal a growing economy. But think about it. If prices don't rise, what happens? It means you could earn $1 million and retire, buy a house for $500,000, a car for $100,000, and live off the rest. Look at Japan. Their prices barely rise, and life is stable, except in Tokyo. Real estate prices in most areas have dropped over time. So, the Japanese have gradually embraced a lie-flat lifestyle, no competition, no striving, just contentment. But the problem is, if more people lie flat, who will work? Who will strive to improve the country? Japan's economy has stagnated for 30 years as a result. From a policymaker's perspective, they must devalue money and push prices up. This encourages people to pull money out of banks to spend and invest, because one person's spending is another's income. If everyone hoards money, society runs out of circulation. Businesses can't sell. And where will they get money to pay workers? If people won't spend, the government prints money instead, lowers rates and triggers inflation, making food, housing, and everything more expensive. This forces you to spend now, because later, your money won't buy as much. Inflation basically drives consumption and investment, kick-starting the economy and potentially raising wages. But does it work in practice? When prices rise, do your wages really keep up? Even if they do, can they match inflation's pace? 10 years ago, some could afford a house, but didn't buy. How many can still afford one now? When the Fed prints money endlessly? In theory, it pumps cash into the market, but how much reaches you? Most goes to cheap loans for big capitalists, who use it to inflate stock prices, luring small investors in. Then they sell off or short the market, cash out safely, and wait to buy low again. That's why the stock market absorbs the Fed's printed money. If it doesn't flow there, inflation would spike consumer prices uncontrollably. Stocks are also how the rich quickly siphon workers' hard-earned wealth into their pockets. That's the essence of finance. Why can the U.S. get rich through finance? Because the world doesn't need to create new wealth. Just transfer and seize what's already there. What's the next problem? Japan wasn't just the first country to push money printing. They also cut rates to negative 0.1%. If you deposit 1 million yen in a Japanese bank, after a year you'd have 900 zeros in yen. Not only no interest, but a 1,000 yen fee. Isn't that contradictory? Doesn't cutting rates and printing money cause inflation? So why doesn't Japan have inflation? This is why US assets can keep rising long term. The US is cheating, and Japan is their cheat code. What do I mean? Inflation in the US is severe, and their debt is massive. If they print too much, the dollar and US bonds become worthless. But if they don't, no one buys US stocks or bonds. The solution? Cheat. Japan cuts rates and prints money. And US capitalists borrow that freshly printed yen at ultra-low rates to invest in US assets. That means Japan's printed money doesn't circulate domestically. It flows to the US. In other words, Japan is printing money for the US. Got the cheat code. That's why, despite Japan printing money and cutting rates, their domestic money supply doesn't grow. Instead, many Japanese convert yen to dollars to invest in US assets. When they sell yen for dollars, the yen weakens and Japanese assets lose value in American eyes. But since the money doesn't stay in Japan, they avoid inflation. A clear pattern emerges. Every time the US faces a financial crisis, Japanese assets spike as money flows back to Japan. US capitalists then buy cheap Japanese assets, the yen strengthens, and Japanese asset prices rise. When US assets bottom out, they sell Japanese assets and reinvest in the US. Buffett and big investors have played this game in recent years. Why? Japan's government guarantees liquidity for stocks and bonds. You can push prices up as high as you want, and when you sell, you won't lack buyers. The central bank will always buy back. It's nearly risk-free investing. But a problem emerged in 2020 when the US started printing money and US treasuries peaked before crashing hard. Over 5 years, treasuries entered a bear market. Prices dropped as yields rose from 1%, yet fewer people bought. Why? If you buy at $140 today, it might fall to $94 to sell, and you lose. Hold. And you wait 10 years to break even. Who'd buy in that scenario? More importantly, Americans used to hold most treasuries. They printed money and lent it to themselves. Before, 65% of treasuries were bought by Americans, with 35% by foreigners. Now that's down to 21%. Even Japan, once the biggest buyer, stopped. China and the UK aren't buying either. Despite Fed rate cuts, Treasury yields keep rising. Now at 5%, a high return, yet they're still hard to sell, and nations are dumping them. The Fed and US capitalists are forced to buy back their own treasuries. So, many predict the Fed will expand its balance sheet, print more money, and buy loads of treasuries to boost their value. Is that right? Yes, the Fed will print more. It aligns with my prediction. The government's out of cash to spend, but will treasuries recover strongly? That's another story. As I said, the world is selling off treasuries. If the Fed tries to cut treasury yields to 2–3% and sell them at higher prices, they'll become even harder to offload, triggering more dumping. The Fed would then have to print more to buy them back. That's why I believe 2025 onward will usher in a hyperinflation era. The Fed's printing will accelerate, once a decade, then every 5 years, 3 years, now maybe 2 years, or even 6 months. Treasuries will get tougher to sell. Only the Fed buying can cause short-term recoveries. But saying treasuries will exit the bear market and return to a bull run, I'm not convinced. The only way to flip this is if Trump wins again, and as he's hinted, launches a global trade war. Chaos ensues, and the world economy weakens. With global investments tanking, people might flock back to treasuries. I believe Trump will try this, but will he succeed? What's certain is the US will print faster, and the dollar will lose value. What's the fallout? Pre-2020, I could eat KFC for $10. After unlimited printing, that same meal costs $20. The Fed's basically pickpocketing us, using our hard-earned savings to pay America's debts. For me, the best hedge has never been treasuries. You might not believe me, but look at what other nations are investing in lately. The answer? Gold. Because the Fed can't print gold. 20 years ago, mining an ounce of gold required removing a ton of rock. Now, it's 7 tons. Costs have septupled. Yet we've been fed propaganda. Buffett says gold's a bad investment. U.S. textbooks claim it's only valuable in war or doomsday. Back then, I wondered, if war breaks out, what's the point of gold? Trade it for food. You'd die faster. The truth, in war, food's king. But since 2000, when the U.S. cut rates, gold's risen 9-fold, while the S&P 500 grew 3-fold. If you think gold's just a bear market asset, why does it outpace stocks in bear markets? If you believe the dollar will gain value, skip gold. You'll need fewer dollars to buy more later. But if, like me, you see a future of massive inflation and a weakening dollar, gold's the ultimate hedge. You'll need more dollars to buy less gold. For me, if I earn $1 million, I'd put 1% into physical gold as a long-term hedge. Sometimes, gold's trending up. Like early last year, I'd invest in gold ETFs or use leverage for futures to profit short-term. When opportunities are slim, gold's one of the rare assets showing breakout patterns we've studied. The risk of buying gold now is just 2%, but if it spikes, there's no ceiling. Insane risk to reward. Some live to sleep soundly, others to wake up. Things seem calm now, but it's always quiet before the storm. Stocks have already started their second correction. Tonight, chaos might return, and forecasts say it'll worsen. But for us, chaos is where the money's made. When one asset crashes, money flows to another. Risk always brings opportunity. I'll share every crisis we investors and entrepreneurs spot with you. What do you predict happens next? Time's short, so I'll wrap up here. We share free insights on becoming wealthy, entrepreneurial, an investor, and achieving financial freedom. Don't want to miss out? Follow my channel and turn on notifications. Share this video with others. I sincerely wish those who liked it achieve financial freedom soon. If just 1 or 2 things I said today help improve your life, I'm satisfied. I'm FortuneCraft. See you next time.